Well, it's just that, I mean, before expenses, the performance relative to the benchmark was greater. So it's easier to establish that that's, you know, before I mean, you're comparing, I mean, it's a bigger number, so with the same volatility, it's easier to establish that this is statistically greater than 0. But, you know, when you subtract the fees, you know, it's just kind of harder to, you know, it's a smaller number, so with the same volatility.
It's a big difference between the fees between the different stock or funds.
Yeah, I mean, the fees were a little bit over 1%. Fees and expenses, in other words, reduced the performance by about 1.2, 1.3% for this category. Right. So that's where the difference is coming from.
Dispersion in these groups?
In terms of within the group, how much dispersion? So yes, there is clearly, I mean, these are averages. So there's certainly been funds in all, some funds have, you know, performed much better, others have performed much worse. In terms of, actually that's something, I mean, I haven't, if you're looking for some like statistics on, I mean, I could, yeah. Anyway, the bottom line is I don't have any kind of simple statistics on like the average dispersion. Yeah. No, yeah, it would be possible to, for example, compute the, let's say, the first quartile and the third quartile, just to give you an idea of like how much, yeah, I mean, that would be actually, that's right. I mean, I think that would be a good thing to do. Yeah. Concentrated was the high tracking error, high active share. It's not, well, it's based on those two measures, so it's not based on the number of stocks. But of course, it does tend to mean that concentrated funds have smaller number of stocks. In terms of what the average number of stocks is, I don't know. A lot of the examples that I looked at had, the more extreme examples have in the ballpark of about 20 stocks. But, you know, so it's in the 20, 30, 40 range, but yeah, whereas diversified guys tend to be in the 100 or so range. Okay, so let me then kind of show you a few interaction terms. Fund size, we looked at fund size and the different categories. Actually, it looks like fund size recently hasn't had such a dramatic effect on performance. It used to be that with the previous data source, smaller funds seem to do a little bit better. You know, now it's kind of, with the updated data is basically, you know, that there's not much going on there. But one thing that did kind of remain very similar to what it was before was the performance persistence. So we see that if you look at the prior 1 year performance of funds, so in other words, you sort funds into quintiles based on how well they did last year, and then you look at what their performance the following year is, you see that the funds that did well the previous calendar year, they actually continue to do well in the subsequent year. So the top minus bottom quintile, you get about 2% difference in return. Okay, so that's kind of, well, that's known in the literature, but what's not known is that that performance persistence really comes from the active guys. So if you look at the diversified stock pickers and the concentrated funds, these are the ones that, especially the concentrated funds, had a huge dispersion in the top performing concentrated guys and bottom performing guys. Remember, this is kind of after, you know, this is following last year's performance. So, you know, there seems to be significant performance persistence for the most active guys. The closet indexers, there's not much going on.
Sorry to interrupt you. Did you also look at how big those guys were that continued their good performance? Were they accidentally also the smaller?
Actually, there's basically no relationship with the with fund size and the performance persistence. So yeah, in fact, if you kind of want, so basically from an investment point of view, I mean, these are net returns. So if you choose the, let's say the diversified stock pickers or concentrated stock pickers, and you go with the high the funds that had a high return in the past year, those are the ones that actually have continued to beat their indices by as much as almost 3% per year, which I think is pretty respectable.
What you normally see is they attract a lot of new money.
Yeah.
They find it very difficult to continue to invest in a very profitable way.
Yeah.
So when you continue this for the third and fourth year, would you still see that they outperform, or would you see sort of?
Yeah. So there's. Yeah, that's a good question. So there's actually some one of my students at Yale, who I was advising. He wrote a paper, and his dissertation was on kind of fund performance, and basically how the top funds attract more assets. When they get more assets, then they'll just scale up their existing positions, so their own purchases will push up the stocks that they're already holding. And that kind of mechanically increases their returns going forward. But then that kind of mechanical price pressure is going to be actually reversed later on. So if you look at the subsequent years, like years 2, 3, and 4, then you actually see underperformance for those funds that have had those high inflows. So that's kind of a pessimistic view on that on this story. That's something that there's some evidence for, but in terms of I haven't specifically separately tested it here, but there's some evidence for that as well. Yeah.
If you compare to the numbers you had, was this 2003? It seems that the stock pickers have a much higher risk than the closed indexers.
The stock pickers have actually, the stock pickers do not have a much higher risk than closet indexers. The one group that is risky is the concentrated stock pickers, because those are taking really kind of high convict, very significant non-diversified bets. Those are the ones that can be very, very volatile. But the what I call here stock pickers, or elsewhere called diversified stock pickers, those are actually, because they're still pretty diversified, they're not nearly as extreme in terms of their returns.
If you look at the adjustment for the last few years, which have been not so good years, you went from 5.1 to 2.7, whereas the concentrated went from 3.2
okay.
to 2.92.
Yeah, okay.
That to me suggests they have a higher risk.
Right. Yeah, so unfortunately, yeah, so I was kind of unfortunately, that's the problem with, I wanted to give you guys the latest numbers because I knew a lot of people would kind of want to know how these funds performed in the last few years and over the financial crisis. The downside is that our data source actually changed. So, it's not exactly the same sample of funds. It's a little bit different. I haven't finished kind of looking into the differences between the fund samples. So for that reason, the numbers that I'm showing you are, I didn't expect them to be exactly comparable with, they're kind of obviously similar to what we had before, but they're not, you can't like really compare them like side by side and say that something happened because of that. So it's a little bit of a different fund sample, unfortunately. Yeah.
Have you found any persistent beta in the active share of the funds, and if so, have you corrected for that?
Sorry, have I found any persistent?
Beta?
Oh.
Active share.
Yeah, in terms of if the high active share funds have just generally, I'm trying to remember if I actually ever tested that. I have computed the betas of these funds. I'm not sure if I ever actually regressed it on active share. Well, one thing that I do know already is that the concentrated stock pickers, those are the ones that kind of have, they're the ones that also have kind of time-varying betas. Whereas the regular and the diversified stock pickers, those are the ones that, because they have relatively low tracking error, they have to have pretty close to 1 betas. Otherwise they would get large tracking errors. So so their betas can't be too different from these guys. They can't be very different from 1. They're going to be pretty close to 1. These guys are going to be a little bit further and kind of more volatile in terms of their betas. Okay. And then, okay, so anyway, so there's some of that fund performance persistence, which I talked about. Now, before I conclude, let me say a couple of words on the financial crisis. So if we just look at the performance 08, 09, and 09 separately, actually first let's look at just 08 and 09, over the financial crisis, in other words. Performance net of fees relative to the benchmark for all of the active funds has been minus 50 basis points per year. So they've lost, it's pretty much in line with the historical average. Closet indexers and these other groups have lost a little bit more. Actually, concentrated funds took pretty heavy losses in 08. And as a result, their average loss relative to the benchmark was actually about 2.5% over these 2 years, so 5% cumulative loss relative to the benchmark. So it really kind of reflects the '08 dramatic losses. But concentrated stock, or the diversified stock pickers have actually beaten their benchmarks by a little bit less than 1% per year over the last 2 years. So it's cumulative 1.6%. So they've actually kind of weathered the storm relatively okay in the sense that they actually did continue to outperform their benchmarks on net of fees basis. And if you look at like '08 and '09 separately, in particular '09 was kind of the recovery stage. This is also what Claude was talking about, how basically this has been a kind of a great year for stock pickers with, as a result of that financial crisis, you kind of got a lot of market dislocations, panicked selling. That really created a lot of, just crazy valuation spreads across, a variety of markets. And as a result, the average active fund has actually beaten its benchmark by 2%, okay, on a net of fees basis, which is pretty much this is like a year when almost virtually, if you, as an active manager, if you lost the benchmark in '09, things really weren't working out for you. It's a year where like about 90% of active managers beat their benchmarks. But the closet indexers still lost the benchmarks. The concentrated funds came back with a vengeance, about like 10% outperformance relative to the index, but they lost so much in '08 that it still kind of didn't fully make up for it. The stock pickers also beat the benchmarks by 5.5%, which was kind of more than enough to offset the losses in '08.
These were all the survivors. What did you do with funds that closed their business? How did you?
These results are not subject to survivorship bias. Because our databases contain all the dead funds as well. So we do, that's not an issue here. Okay, so just recent performance, active share group here in the top, closet index funds. Anyway, so that you kind of see that. This is from '08, '03 to '09. You kind of see the similar, you see that the high active share funds kind of did, they did take bigger hits in the crisis, but then they kind of came back much more strongly afterwards. All right, so then let me actually conclude. Let me just say a couple of words. A couple of general comments here. So how can we use active share as practitioners? Well, you can use it in a couple of ways. So you can use active share to identify better performing funds. Now, would we expect this relationship to continue to persist in the future? I think I would expect that to happen, and this is for 2 reasons. Number one, as an active manager, if you want to generate alpha, the only way you can generate alpha is by deviating from the benchmark index. Mechanically, if you're very, very close to the benchmark and you're charging fees for active management and you're also turning over your portfolio and paying fees for transaction costs for that, you're not going to be beating your benchmark index or an index fund, kind of a low-cost index fund tracking that index. So that closet index funds are basically guaranteed to be a drag on your returns. And that's, and the only ones that even have a hope of outperforming the index are the truly active managers. So in that sense, if any active managers outperform, I would expect it to come from the truly active ones. Whether it comes from the most extreme active or somewhere in the middle, that's an empirical question. But at least one thing that you know for sure is the least active guys will always underperform. Now, secondly, this is not some like random measure that we came up with to kind of mine the performance data. Basically, we wanted to write a paper on kind of quantifying active management to really understand what type of active management, like the different styles of active management, diversified stock picks and factor bets and so on. And later on, we also tested a relationship to fund performance, and we found that there is predictive power as well. But anyway, so this is not, but it's kind of an active share, and these concepts that I've discussed are kind of pretty simple. They're really kind of economically motivated and not some kind of arbitrary measures that we chose. Now, of course, as a finance professor, I have to give you the usual caveat that anyway, like whenever you find something that kind of helps you beat the market, you have to be a little bit careful. We would expect that, just economically, we would expect that whenever there's some anomaly, that would never exist kind of forever. at some point it would be wiped out in the marketplace. The market would adjust. But having said that, some anomalies have persisted for years. Even like, simple things like price momentum, earnings momentum have persisted for years. Yeah, it's true that they haven't performed well in 07 and 08, but basically, I mean, those are things that people have known about, since the 80s. And they did well like throughout the 80s, throughout the 90s, pretty much all the way up to 07. So anyway, so there are certainly some anomalies that have persisted for a long time.
So active shares should be very easy to calculate for a company like Morningstar Litmer. They didn't put it on their website yet.
Yeah. So let me just, I'll get to that in just a second. It's actually on the next slide. But let me just say, other uses of active share, if you want to understand the types of active management, then you want to, active share is a useful concept there, especially if you're paying fees for active management. And it helps you better understand the risks that you're exposed to as well. I mean, of course, you could just listen to what the fund managers say or read their prospectuses. But I mean, how do you really know that what they say in their prospectuses is kind of an accurate description of what they actually do? Well, if you compute the numbers based on holdings, based on returns, I mean, that gives you a reliable picture of what's actually going on, regardless of what the fund managers say. So that's useful. Now, so going back to the question on where do we find this data? So it has been actually difficult to get until kind of pretty recently. So actually, a lot of people asked me about it. So what I did was I actually put up my old data on my website. It ended up, it goes on until the end of 06. The plan is to update it, also the public version, update it to the end of 09. And that's obviously available for free. Now Morningstar has actually they've actually been planning to compute this and report this for investors for a couple of years now. I gave a talk at one of their investment conferences a couple of years ago, and at that time they were already advertising that they were in process of doing it. They finally did it just a few months ago. They finally came up with they finalized their product. The problem is that it's a little bit difficult to use. I mean, it's not like a simple data point. You actually have to define, for each fund, you have to separately define a benchmark index, and then their software, Morningstar Direct, will kind of compute it separately for you. But it's not a data item that you can just easily look up for like 2,000 funds. Okay, so that's a difficulty with. I mean, I'm not very happy. I mean, I've been into some discussions with them. I'm not very happy with the way they've implemented it, but anyway, that's the way they've done it so far. Mutual Decision is a website subscription-based service that actually reported. Actually, it allowed you to sort funds based on different criteria, including active share, and kind of give you the top funds. Unfortunately, that subscription-based service didn't apparently generate enough cash flow, so it's actually right now it's no longer available. They're kind of looking for new investors. But they did run their service at Mutual Decision for about a year, and they had 4 academic models that they used to select stocks. So this is from active share and then 3 other papers. So here's the return over the time period that they ran their models. So active share funds actually earned 33%, beating the S&P by 18% over this time period. So it's over that 1 year, it was a pretty remarkable. Obviously, it was a good time to be investing in active managers, but anyway, so they certainly over that time period, it kind of worked out pretty well. So anyway, so I think I'm a little bit over in terms of my time. So let me just conclude. So we've kind of introduced this concept of active share to quantify active management. You can use it alone, or better yet, you want to use it together with tracking error to get a more complete picture. And then in the paper, we've got more statistics on kind of general cross-sectional patterns in active management. But in terms of performance, I think the bottom line is, the most active funds, especially the stock pickers, tend to be the one that beat their benchmarks before fees as well as after fees. Okay, so these are the guys that you as an investor, you kind of have the best hope for in terms of having some outperformance net of the index and net of fees. So that's kind of that's the bottom line of the talk.